Welcome to your Wealth by Design, a low-stress systematic approach to investing. This is my attempt to build that system. This content is for entertainment and informational purposes only. This is what works for me and may not be appropriate for you. I am not a financial advisor and this is not financial advice. So please do your own research before making decisions with your own money. Let's take a look at the portfolio today. Today we squeaked by 0.05%. I'll take it. That means every single day we have beat the market since the beginning of the year. Even if we had gone negative, we likely would have beat the market. S&P 500 was down 0.21% today. A beat plus a green, I will take it. Let's find out what that calculates to. If the S&P was down 0.21 and we were up, that would equate to a 6.2x on the market returns for the day. Now, the math gets a little difficult to wrap your head around once the numbers go negative, but just imagine if the market was down 20% today and we were also down, but only down 10% today, it would be fair to say that we doubled the market. Our portfolio fell half as much as the market did. So we would have 2 times the returns of the market. Once you go positive, you would then need to pretend like your portfolio was negative for the math to make sense. So we would have to first reduce our holding to 0. That's 1 unit, and then reduce it further to a negative number. So if we pretend like our portfolio is a negative number, we had to subtract 0.05 to get to 0, and then an additional 0.05 to make it negative. Once both numbers are negative, we can divide the numbers and then get a return. So if we do that, we get 6.2x. Fantastic. Every day since the beginning of the year, we have beat the market, which is why our returns are so high. If every day you go up more than the market and every day you go down less than the market, you're going to mathematically win because recovering from a loss takes more effort than simply being flat. Let's go and run through all our index comparisons. We were up 0.5 today. The world index was, down to flat. I would say it's pretty comparable to our results. We're both pretty much flat. I'm up flat, they're down flat, essentially the same. This is noticeably down. We crushed the S&P. And QQQ, we destroyed the QQQ. QQQ is tech heavy, and tech had a major sell. It's interesting, yesterday we were noticing that, real estate. Let's sort this by returns for a second, just so we can find what we're looking at. Real estate, and I want to say we talked about industrials yesterday. I know for a fact we talked about real estate. And real estate was down yesterday as it rotated into tech, but today we had the opposite rotation. Back out of tech and back into real estate. We'll have to check the portfolio in a minute to see if this bump was enough to establish a trend or if it's still in a downtrend. So a lot of these 2% holdings that are seeing a bump today have been in a downtrend. Now, today may be enough to establish a new trend, in which case they'll get bumped up in our model. But if not, it's just interesting to see the rotation going back and forth here. The market's trying to decide who the winners are going to be over the coming weeks and months. If we look at the return on the week, we're sitting at 3.43. The world index is about half that. S&P 500 is significantly less. QQQ is about half that. So we are currently doubling. If we look at year to date, we are double the world index. We are 3x the S&P, and we are more than double the QQQ. We are crushing it. Let's take a look at our current trends. So I've sorted our portfolio by our target weight. We can see how we expected things to play out today and how they actually did. So gold had an amazing day yesterday. It's taking a bit of a cool off. Same with silver. Amazing day yesterday. Taking a cool off. Not a big deal. It's not seeing a sell-off. It's just flat. Interestingly, small caps, which are mostly commodities miners, copper, gold, silver, all that kind of stuff, and the industrial equipment to do that sort of operation. The mining activity is still going strong. The direct commodity price is taking a breather. Of course, these companies are going to have, they're going to lag the commodity because they're seeing increased profitability because of the commodity price rising. So we're going to continue to get a tailwind from the actual equities that are profiting from the commodities being up. Emerging markets down quite a bit. Let's see what's in there. Mostly tech. Okay, part of the tech sell-off, I would assume. Oh, yes. I forgot that Taiwan is considered an emerging market. Yeah, TSMC, Tencent, Samsung, all the tech bubble, seeing a bit of a sell-off today. So that would explain why it's down. Pacific X Japan is up. That trend is continuing. This is mostly financials and Australian heavy industry. International mid-caps up very strong. DIM was the only ETF I could find for international mid-caps. It just happens to be a dividend-themed fund. So I would imagine it's going to be mostly financials. But we've got, a decent exposure, 75% of it to other industries. Financials, pharma, I don't know what a lot of these are. A Finnish state-owned energy company. Okay, Fortum Oij. Interesting. I think this is a good time to point out this is why holding these ETFs is so powerful. I don't know what this Finnish oil company is, but if it's a mid cap and it's grown to be included in this index, well then it's proven itself to be profitable and stick around, and I want exposure to that. It happens to be up today, which is fantastic. Great. That's why we diversify. It says Europe is up strong. Let's see what Europe's got going on. We got ASML. Oh, ASML is up huge, 2.25, which is interesting. Yeah, so we're seeing the tech companies sell off, the manufacturers sell off, but the machines that allow the whole industry to explode are up today. Interesting. I think this is kind of funny. It's like, how is it the news of the century? ASML reports record orders for AI chips. Somehow this was news today. ASML just reported their earnings yesterday. They missed on their earnings, but the stock price went up. Investors ever cautious about this AI tech boom being a bubble. And for now, I guess their fears were abated and the stock price went up. Wow. So not just ASML. This would explain why the Europe core is up. Healthcare is up. ASML's up. Financials up. Strong day for Europe. Let's check out American Energy. American Energy Exxon is up huge today, 2%. I think it's interesting to see why these companies are up or down, but it doesn't really matter to us because we hold everything. Have not reported their earnings yet. Not sure why it's up so much today. Maybe it's getting a run up before the earnings, but we need all this energy to power all the tech. So we'll see if energy can keep up. Largest holding up, massive. Energy going strong. Okay, so that's the top performers for our strategy. If we look at the middle, seeing industrials up, communications are up huge. Now I looked at this earlier. Communications were down because Meta was down, and everyone is saying that Meta saved the day or saved this sector, but that's totally not the case. Yeah, it's up 10%, but if you look at all the holdings, Google's up. Google's got the same weighting as Meta. Disney's up huge, 2%. Verizon up huge, 1%. AT&T up massive, not quite 5, but 4.33. So you're looking at 35% of the sector is up huge. That's not even counting Meta. So there's a lot going on in this sector, and it's not Meta specific. Meta was seeing net sales. I think they're just buying the dip. Meta did have strong earnings, which is interesting to point out because we're about to transition over to the model and see how the model's handling today. But we care about trends. We want to identify the future winners, not the one-day pops. Some of the biggest losers keep losing. If we look at trend the past week here, crypto continues to fall. We continue to hold a minimum position size, and our biggest losers, healthcare, has been continuously falling, because they will turn around at some point. Let's go ahead and transition over to the model so we can take a look at this. Our model is successful for many reasons, but two primary focuses allow it to outperform. This half is trend following. We identify who's winning and we buy more of who's winning. This half is mean reversion. We're going to maintain a minimum position in them so that the moment they do establish a trend, we're not starting from zero. We're going to benefit from the dollar cost average into these negative trends, but we're not heavily chasing value. So we don't have to, catch falling knives. We're always going to be benefiting from who's outperforming in any given market. I do think it's interesting to note that fear was elevated yesterday and we had a sector rotation today. Today, fear has been alleviated. They needed to move some money around and now they feel good about it. There's probably a lot of anxiety going into earnings for some of these major companies. And I guess they got the news they wanted to, or at least they know, right? The market does not like uncertainty. So I think as uncertainty was reaching its peak, fear was increasing. Now that we have some clarity regarding the current market conditions and its future, fear is coming back down ever so slightly, which will cause our DCA to increase. Interesting. It's important to note that I think this Friday is our last Friday of the month, we will update our cash balance to our current cash holdings for the next month. If y'all are interested where I keep my cash and how I get the maximum possible yield, let me know below and I'll delve into the specifics of my savings account. Let's take a look at the shakeup. We're seeing most of our top trends maintain. This one, materials, has dropped. Top holding is up. It's an energy company, Newmont. Down huge today. Oh my gosh. This is a mining company. News is citing it's just they're just capturing gains. These companies are going to lag the price of the actual commodity. So, I mean, I think people are just profit taking and the trend will continue, which is why it still holds strong in our model. It's just been bumped down a little bit. When I update, it'll get bumped down a little bit. Industrials saw a huge pop. That's going to get pushed up quite a bit, along with communication services. We've already taken a look at communication services. That was your AT&T, your Google, your Meta. Comcast was up big today. That pop was enough to push it up quite a bit to establish a new trend. So we'll see if that trend continues. Our broken trends, Ethereum, I don't remember if that was established yesterday. Ethereum is taking a beating. This is a massive negative trend. BTC, massive negative trend. This is going to be a huge buying opportunity at some point in the future. And when it switches over, we will catch it. We'll be ready. Let's go ahead and update the model. Our holdings are mostly the same, save the few alterations we discussed. Here are the holdings next to their tickers. I will go ahead and update the holdings in the portfolio according to these weights right after the video. Today was another strong day for the portfolio. I think it's important to point out that our diversification has saved us on many occasions, even though we're tilted towards the trend. By holding on to every uncorrelated asset, they're going to surprise you sometimes when there's sector rotations. Because I'm always holding them, I can react instantly to the market overnight while I'm sleeping. I don't have to monitor my portfolio 24/7 and constantly be trading in and out. And days like today are great examples of that. Gold and silver leveled off. These trends mostly maintained. And we got a few surprise pops down here. Continued dollar cost averaging into the most extreme negative trends. I think the model's holding up exceptionally well. Today we were able to be slightly green, but even if it was negative, even if we were slightly negative, by being able to be down less than the market means we need less work to get back to where we were. Mathematically, if the market falls 20%, it's not a 20% to get back to where you were. It's more than 20%. So by falling less than the market, we're constantly losing less money, which means any future gains are starting from a more stable base. Anyway, today was a good day. The model is holding up extremely well. The returns are robust, and I'm excited for the future. I really want to see, days like today are very interesting because I want to test the model. You know, beating the market every single day is good. It's great. It's good for the pocketbook. It makes me feel good about myself. It's good for clicks. But I want to be surprised every once in a while. I want to make the model as robust as possible. I know that I've attempted to plan and foresee everything that I possibly can, but I may have missed something. And when that day comes, I'm going to be very excited because I'll have the opportunity to correct it and learn and see what I missed. But for now, the model's handling anything the market can throw at it. So I appreciate you stopping by, and I'll see y'all tomorrow.